In the 1980s, Japan looked unstoppable. Its economy was booming. Companies were expanding across the world. Real estate prices were skyrocketing. And its stock market kept climbing higher and higher. At one point, Japan was on track to become the largest economy in the world. There was even a moment when people believed Japan wouldn't just compete with the United States, it would surpass it. But then something changed. Not gradually, not slowly, but all at once. The market collapsed. Asset prices fell. Banks began to struggle. And the system that once looked unstoppable started to break down. This was the beginning of what became known as Japan's lost decade. But here's the strange part. It didn't just last a decade. Years passed, then another decade, then another. And the economy never fully returned to what it once was. Growth slowed, prices stopped rising, and the country became stuck in something economists call stagnation, where the economy barely moves forward. So the question is, what actually happened? Because economic crashes aren't unusual. Most economies fall and eventually recover. But Japan didn't. Not in the same way. And that's what makes this story different. Because this wasn't just a crash. It was a system that couldn't restart itself. And the deeper you look, the more it becomes clear. This wasn't caused by one mistake. It was the result of something much bigger. A combination of decisions, policies, and structural problems that turned what should have been a temporary downturn into decades of stagnation. And once that process began, it became incredibly difficult to reverse. Because when an economy slows down this much, it doesn't just stop growing. It starts reinforcing its own weakness. Less spending, less investment, less confidence, until the entire system settles into a kind of equilibrium, where nothing really moves. And that's where Japan found itself. Not collapsing completely, but never fully recovering either. So the real question isn't just, why did Japan's economy crash? It's this: why couldn't it recover, even after decades? To understand why Japan never fully recovered, you have to go back to what caused the collapse in the first place. Because the crash wasn't random, it was the result of a bubble. In the late 1980s, asset prices in Japan weren't just rising, they were accelerating. Stocks climbed rapidly. Real estate became incredibly expensive. At one point, land in Tokyo was said to be worth more than entire countries. And for a while, it felt justified. The economy was strong. Exports were booming. Companies were expanding globally. But underneath that growth, something was building. Debt. Cheap money had made it easy to borrow. Banks were lending aggressively, and businesses, and even individuals, were taking on more and more leverage. Because as long as asset prices kept rising, that debt didn't feel risky. It felt like an opportunity. But just like every bubble, it depended on one thing: prices continuing to rise. And when that stopped, everything began to change. In the early 1990s, the Bank of Japan stepped in. Concerned about overheating, they raised interest rates. And just like that, the conditions that had been supporting the system started to disappear. Borrowing became more expensive, investment slowed, and asset prices began to fall. At first, it looked like a correction, but it didn't stop there. Because once prices started falling, the entire system began to unwind. Companies that had borrowed heavily suddenly found themselves with assets worth less than their debt. Banks that had lent aggressively were left holding bad loans. And confidence, the thing that had held everything together, began to disappear. This is where most economies eventually stabilize. Bad debt gets cleared, weak institutions fail, the system resets. But in Japan, that didn't happen. Instead of allowing the system to fully adjust, something different took place. Banks continued operating, even when they were carrying massive losses. Companies stayed alive, even when they weren't productive. And debt was never fully cleared, which meant the system didn't collapse completely, but it didn't recover either. It became stuck. Economists sometimes call this a balance sheet recession, where instead of spending and investing, businesses and individuals focus on paying down debt. And when that happens across an entire economy, growth slows dramatically. Because money isn't flowing. It's being used to repair balance sheets instead of driving new activity. At the same time, another problem started to appear: deflation. Prices began to fall, not just for assets, but across the economy. And while that might sound like a good thing, it creates a dangerous cycle. Because if prices are falling, people delay spending. Why buy something today if it will be cheaper tomorrow? And when spending slows, businesses earn less. They invest less. They hire less, which puts even more downward pressure on the economy. And this is how the system reinforces itself. Debt slowing growth, falling prices reducing demand, weak demand leading to less investment, a cycle that becomes incredibly difficult to break. And even when policies were introduced to try and fix it, lower interest rates, government spending, the system had already adjusted to this slower pace. Confidence wasn't coming back the same way. And without confidence, the economy couldn't fully restart. Which is why Japan didn't just experience a crash, it experienced something far more unusual. An economy that continued to function, but never returned to the level of growth it once had. And once a system settles into that kind of pattern, it raises a much bigger question. If an advanced economy can get stuck like this, could it happen somewhere else?
So if Japan didn't collapse completely, why did it never truly recover?
Because the problem wasn't just the crash. It was what happened after. Instead of resetting, the system adjusted. Debt remained, weak institutions stayed in place, and growth never fully restarted. Which created something unusual, an economy that continued to function, but at a much slower pace. Not growing strongly, but not collapsing either. And over time, that slow pace became normal. Businesses adapted to lower demand, consumers adapted to falling prices, and expectations began to shift. Because once people stop expecting growth, they behave differently. They spend less, they invest less, they take fewer risks. And that mindset reinforces the system, because an economy doesn't just run on money, it runs on confidence. And when confidence disappears, even the strongest systems can struggle to move forward. That's what makes Japan's situation so important, because it shows that recovery isn't guaranteed, even for a developed economy, even with advanced institutions, even with decades of time. And that leads to a much bigger insight, because the same conditions that created Japan's stagnation, a massive asset bubble, high levels of debt, an economy dependent on continued growth, they're not unique to Japan. We've seen similar patterns in other countries, at different times, in different forms. Which raises an uncomfortable question. If a system becomes too dependent on growth, what happens when that growth stops? Because Japan's story suggests it doesn't always recover the way we expect. Sometimes, it just settles into something new. slower, more fragile, and much harder to change. And once you understand that, you start to look at other economies differently. Not just in terms of how fast they're growing, but how sustainable that growth really is. Because the real risk isn't always a sudden crash. Sometimes, it's what comes after. A system that keeps running, but never fully recovers. This is Empire Economics, where we break down the systems shaping your world, one story at a time. And once you see it, you can't unsee it. Thanks for watching.